Welcome everyone to the 7th Annual Global Volatility Summit, the one-of-a-kind event which continues to challenge the conventional methods of knowledge transfer through its annual conferences and dialogue throughout the year about volatility and options trading. The theme today is the global supermarket. The content, the presentations, the panels, and the speaker lineups, they've all been purposefully selected to really be topical around the market volatility concepts that we expect to experience in 2016.
Many of you have been coming to this conference every year since we launched in 2009. And I hope I'm right in thinking you all feel more confident in saying, yes, I may not understand it fully or 100%, but it's worth exploring. I think that's been the biggest shift I've personally seen since I've been standing up here for all these years, is how investors are now thinking about volatility and how it can be used within their portfolio. The sophistication of the investor has really pushed the conversation deeper into really multiple methods of how volatility strategies can be deployed from the options and volatility markets. And I would like to think that this conference has played a small role in that deeper evolution.
We certainly saw with the new regulations, rather than complaining about the lack of liquidity in the marketplace, that it really is a great opportunity, as banks don't have the ability to commit capital like they used to. So that's actually been a real growth area in the last couple of years, as banks are no longer internalizing all their accelerated share repurchase programs.
When you look at the volume of the S&P futures, looking at the volume and looking at what we would call the depth, that number actually has been declining a lot in the S&P market.
FX is definitely also something very interesting, and certainly the place where you see the biggest differences across the various pairs and the biggest diversification potential. Depending on the type of pairs you are trading, you can get a lot more diversification and a lot more stability when trading volatility as well.
In my view, skew has now repriced to the upside, but it doesn't mean that it's the wrong position, because actually the Vega, the VANA, the correlation between the volatility and the underlying actually is now so negative that the skew has become fair. So on a carry basis, you can justify being long those positions there.
If investors are having problems generating yield and are searching for that in other asset classes, one simple way to do that would be to use volatility. The implied volatility that is embedded in option prices tends to trade at a substantial premium relative to realized volatility.
So if I sum up the idea of systematic strategies, it's all over the place from investment to hedging, and it always looks for delivering performance at a very cheap and cost-efficient price. There's a lot of things about the systematic strategies that in fact make the product a lot more robust, a lot more professional, more difficult to enter into that business. In fact, because it's performing more and more, the regulation and the market is there for us to develop and to be successful.
Systematic strategies move things at the margins during the first few days of that week of August 24th. I think it would be a stretch to say that all of that was caused by positioning or systematic strategies. A lot of it was fundamental driven and perhaps liquidity related. There was a large number of investors who are using VIX options now, and that created sort of a short positioning in terms of market makers. And as the market moved, this was the first time you really saw that effect, that you had a very large short interest in VIX options, and that caused exacerbation of some of the moves that we saw in VIX futures.
I think most of us assume that we're optimizing to a certain specific set of constraints where we, let's say, increase Sharpe ratio, maximize Sharpe ratio, increase performance, lower risk. When there's new regulation that's introduced, that forces somebody to optimize to a completely different set of constraints. What that does is it opens up opportunities for someone to take the other side.
You know with backtests how they perform in the past, you know with the stress tests how they're going to perform in the future, but they are simple enough that actually you can put many of them together and they can give you the type of performance risk-adjusted that you're expecting.
Bank-based systematic strategies are putting much more onus on the end investor in making the decisions.
I got to be the chairman because of my intelligence, my parliamentary skills, my good judgment, the fact that one guy died Another guy got defeated for re-election, and a third one ran for the Senate, because it is entirely based on seniority. Those of us who passed that bill thought of ourselves, and still do, as believers in the market. There were only two parts of the financial reform bill that are prohibitions. One is we did make it illegal to lend people money to buy a home when there was virtually no chance that they could repay it. The other thing that was banned, I was opposed to. In the Senate, they got a bill through that we had to accept in the House Conference Committee, which gave the Federal Reserve the power to set the fee that credit card companies could charge retailers. That's a fight between two financial interests. I don't think the consumer had a horse in that fight. The Fed said it didn't want to do it, but we couldn't stop it.
Very often, being long options is compared to being long some level of insurance or some protection against market downturn. So when you're long in insurance, you would expect to pay a certain level of premium to own that insurance. You're not paying a premium, you're actually getting paid to own protection or to own insurance. And you can actually build a portfolio quite easily where you're getting paid to own protection.
We have call-put parity. We don't distinguish between calls and puts. For the same reason, calls and puts are equivalent. It's the optionality that you want to buy or sell. It doesn't matter whether it's in calls or puts, because delta hedging can take care of the difference. So calls and puts are kind of equivalent.
The first step in going beyond the headwind is to think about vol not just as a single strike and single maturity, but rather to look at the whole volatility surface itself. And in particular, to actually look to use the shape of the volatility surface to identify what underliers you want to own volatility on.
Credit vol is behaving the way vol has behaved in equities. And one of the reasons for that, fundamentally speaking, is the sector distribution. We haven't seen real fundamental problems in other sectors. And the other aspect is that realized vol has been low. We didn't get a flash crash. This has been a very slow, gradual, painful widening of spreads. And therefore, realized vol has been low, and implied vol, therefore, hasn't moved as much.
2016 presents a fair amount of opportunity, tactically speaking, in interest rate volatility for three main reasons. The Fed's in motion again for the first time in years, the divergence of central bank policy, and then a re-examination of the lower bound on interest rate policy that had previously been deemed to be zero or zero-ish, that is now being re-examined by the major central banks from around the world. The best opportunity on the board right now is in skew on the front end of the US interest rate curve. US, Europe, and Japan, there's a very strong relationship between the level of interest rate and the level of volatility.
Increased regulation has resulted in declining liquidity in almost every market that you look at. Anyone who interacts with the treasury market on a daily basis can confirm that it just behaves differently now. There's just a decline in risk-taking activity and risk-taking willingness on the part of the market makers. You know, it's a result of the increased risk-weighted asset charges for Dodd-Frank and Basel III rules that really have resulted in massive declines in corporate bond inventories.
In terms of tail risk management, particularly as it relates to vol, in the olden days, we could quote 1 or 2 million Vega of 10-year put option, for example. To do that these days is very tough to do. So generally, what the most insurance companies have done have either migrated to the shorter part of the curve, meaning maybe using the 5-year point, or develop a different program entirely, like a vol control product.
Vol control funds will deallocate out of equities when markets are choppy and reallocate when things are calm. So you underperform in up markets, you outperform in down markets, but over the whole cycle, you believe that the customer is going to get the same benefit he or she was getting under the old fixed allocation model.
At the fund level, you may have a fund that has a target volatility range for realized volatility, and it will rebalance out of equities into fixed income. And by doing that, it will try to achieve its target volatility realized over a certain time window. At the policy level, effectively, We, as an insurance company, have issued a strike to the policyholders. And relative to that strike, the allocations in and out of equities can take place. Between the two together, you have a pretty formulaic approach to dealing with volatility. Pro-cyclical tends to, when markets decay and decline, you end up with more volatility around the volatility.
Losses can be basically infinite, right, if you're not careful. So hence governance is the most important issue when doing derivatives internally. We use simple linear derivatives for the most part. We do not use exotic derivatives. We use derivatives for beta replication and portable alpha strategies. So we use, most importantly, swaps to maintain our beta to roughly 1 with the MSCI World. And we also use swaps and futures and sometimes options to increase or decrease the internal exposures.
We think of ourselves as sort of locally flat markets, but clearly when you run a large hedge fund portfolio like we do, you find that beta creeping in, and clearly the scenario where you don't need the beta. We're sort of cognizant of trying to sort of map out what we think our managers are going to do in that down state of equities, so that's what we're focused on. So I think the more complacent risk is exaggerated taper tantrum risk, which is the equity markets down 20%, rates up 100, or some sort of scenario like that simultaneously would cause a lot of trouble.
In the absolute return portfolio, definitively the preferred route is indirect. So we have some managers that help us gain access to those risk premiums. I believe generally volatility is a risk premium. I think vol is much more our job to do active management to some extent. And how do we dynamically rebalance our portfolio? Is it systematically? Is it discretionary? Is it over multi-period? To some extent, when I sell vol, I just sell some future flexibility in my portfolio. I think it's much more related to how much active management you want to do in your portfolio. And vol is just a way to express that active management.
Some of these strategies, banks don't have a patent on them. Anybody could do them. Well, it's all about how much capital you have, and obviously the banks had access to capital. Post-financial crisis, you maybe saw high-frequency equity traders take advantage of this. You don't need a lot of capital to do that business, and they were immediately able to fill some quasi-market-making roles.
Just as basic as you can get it is we learn how to harness fear, all right? Because there's a difference between being afraid and having fear. Now, being afraid will cripple you. It's a fine line between the two, but if you can harness that fear part of it, man, you think you could do anything. That's what they teach us. My primary mission set in Afghanistan, they would slip us into the cover of darkness. We'd either free fall out of an airplane, fast rope out of a helicopter, go on horseback, Humvee, whatever it was, and sneak into the mountains as deep as we could possibly go for weeks. And our job was to hunt down the head of the snake and find him. I mean, everything else had been shredded off of me. My maps, GPS, compass, med gear, everything was gone. I had my rifle and one magazine left with 11 rounds in it. That was it. Well, I just rolled over and started crawling. I'd fragged from the bottom of my feet, top of my head, been shot, back was broke, shoulders torn out. I was pretty jacked up, man. And I crawled into this crevice and I buried myself in a shallow grave. And that part earlier when I was talking about being afraid, this is where it happened. I was scared to death. I can't tell you anything that's going to change your life, man. Just know that everything that I had been through and made it through is just because I refused to stay down. And you wake up the next morning and do it again, man. Go as hard in the pain as you possibly can, because if you knew how fast your life could be snatched away from you, you wouldn't waste 1 second doing anything that didn't bring you absolute enjoyment.